Welcome to Decrypt, Asia's first blockchain and cryptocurrency podcast. I'm your host, Tushar. Each week, we take a deep dive into the Asian blockchain scene with investors, technologists, and industry insiders. Go to decrypt.asia to subscribe to our newsletter and follow us on Facebook, Twitter, LinkedIn, and Telegram to join in the discussions. Hi, guys. Today, I have perhaps the most interesting and most experienced guest in the blockchain space that we've had in the short history of this show. Our guest for today's show is Meher Roy. Meher has been active in this ecosystem since about 2013. He's a fellow podcaster and host of Epicenter, one of the most well-respected blockchain podcasts in the industry, with guests such as Vitalik Buterin, Adam Back, Gavin Andresen, Ralph Merkle regularly featuring on his show. He has also recently started a new company called Chorus One, where his company is building validator nodes for proof-of-stake blockchain networks such as Cosmos. Meher is a graduate of the Indian Institute of Technology, or IIT, and worked in the pharmaceutical and healthcare industry prior to making a switch to the blockchain world. A quick note here before I begin. I ended up talking to Meher for close to 2 hours. As a result, I had to split this episode into two parts. In the first part, we'll talk more about the company he's building. And in the second part, we'll talk about his investment philosophies and the mental models he uses while making investment decisions. Welcome to the show, Meher.
Thank you. Thank you, Tushar.
Well, first of all, I want to thank you for all the support and the advice that you've given me during my podcasting as well as blockchain journey. It's been great to bounce ideas off of you and learn from your experiences.
I'm happy you're doing a podcast in the crypto space, and I'm personally happy to see podcasts come out of India and Asia in general.
Yeah.
When I started out in the industry, there weren't any people doing this out of India. I'm really happy that way.
Yeah. Well, I'm based out of Singapore now, so there's not too much activity going on in the blockchain space in India compared to Singapore. I mean, Singapore is, I think, operating at a different level at the moment.
Yeah.
Yeah. It's crazy. I mean, every cafe, restaurant you go to and people are talking about crypto. But I mean, that's a separate point. So I want to start off with an observation that I made recently. I noticed that you went off Twitter, where a lot of crypto talk happens. Is there any particular reason for it?
Yeah, I think there are a few reasons for it. The main one being, so first of all, it's an experiment. I wanted to see what life feels like without social media. So I also deleted my Facebook profile. I went off Twitter. And the final thing that remains is LinkedIn, which I will also get rid of. So it's an experiment to see what life is like without social media. It does have its advantages. The chief one being that I listen to my wife much more when there's no social media.
Yeah,
I'm having dinner.
She's not complaining.
Yeah. So for example, when we are having dinner, no Twitter. I actually focus on her, and she likes this better. But on the professional side, I sort of observe two things about Twitter. So the first is that, especially like when you look at crypto Twitter has a way of generating a lot of small fleeting emotions in one's mind, right? For example, like what's an example of a small fleeting emotion? Let's say you hold asset X, some relatively famous person says something against asset X, right? And you read that message and you read those conversations. Even if you have really good self-control, you'll have an emotional reaction to that conversation. You'll think about it for the next, 6 hours, 7 hours. And I felt these were distractions I just didn't need, like these surges of emotion in one direction and then in the other direction. That was one thing. I wanted less emotion in my life that Twitter brought about. And The other thing professionally I wanted to try out was to test what it does for productivity. And I feel going off Twitter raises my productivity a lot. These days I'm building a company, and it's best for the company if I like stay away from conferences, stay away from social media, and just do the actual work of building the company. Sort of these are the reasons why I went off Twitter, to avoid emotional surges, to be more productive, and then actually the benefit I didn't realize but does exist is, to pay more attention to family and wife. Yeah.
But don't you think in general there's a trade-off between productivity and building your personal brand, even for your company, even professionally? Don't you think that brand comes in handy in terms of when you're looking to either hire people or, get on a new client, so to say? I mean, perhaps that's not applicable in the business that you're building, but don't you think that, I mean, there's obviously a trade-off, right, in terms of building that brand versus increasing your productivity?
Yeah. From a company perspective, if I look as a company, now I'm on the technology side in the company, right? The company needs to build a brand. And of course, there'll be like social media manager, there'll be like marketing officer, whose main job will be to maintain a good Twitter profile. So I don't think the company suffers from me not being on Twitter. Right? I'm not a journalist. I'm somebody building technology, and it's probably better for the company I do that well. The second scenario is more interesting. That is about personal brand. So I feel my most high quality, like, what is personal brand, right? So personal brand might be the network of people that know you, and the network of people that would value your insight if you were to produce any, right? So it's like the network of people that would know me, and then if someday I have an insight, let's say a governance insight on some blockchain network, and I write an article, the number and the quantity and quality of people that would read my article and respond to it and change some of their approach to a network in a particular way because of my article. So I think that is really a brand. Now, my personal perception is that if I look at my personal brand, I think most of it is made through Epicenter. Like 80% of it is made through Epicenter. Twitter might play a very small role in it. So I have a feeling that if I just restrict Twitter and I do Epicenter really well, it doesn't harm my brand in any way. Second thing is, I also don't want to worry about personal brands. Like, this is the age where everyone has become a personal brand, and everyone worries about their brand. I don't want to be part of this system at some level. Like, it's okay to not have a brand. Yeah, it's okay.
Yeah.
I mean, it's more important to produce great work in whatever we are doing, podcasting, building technology. Just produce great work, and the brand usually takes care of itself. Spending 2 hours tweeting to build a personal brand, I think is suboptimal.
Yeah. I think I tend to disagree a little bit, but I think I'll let the matter rest there. We got a little carried away, but so just to tell the listeners about your background, could you tell us about when and how you got involved in the blockchain and cryptocurrency space, and how that journey's been like for you?
So I came across Bitcoin when The Economist published an article in 2011. For me, it was clear, like, it was interest at first sight. I read The Economist article, and I felt this technology was interesting. I dug into it in early 2012. 2012 was when my first attempts to purchase Bitcoin happened. I didn't succeed at first, actually, because like it was really hard to buy and store Bitcoin in those days. And then came a phase where I forgot about it. Other things in life took over. My interest was rekindled in like 2013 when there were like two bubbles. So March 2013 was one bubble and November 2013 was the second bubble. So the first bubble took Bitcoin from $3 to 100, and the second took it from 100 to 1000. And since I already had an interest in it, my interest was like, so I tend to read a lot of stuff. For example, this day right now I'm studying zoology. So my interest in Bitcoin was more like that. It was a hobby. But then when these bubbles happened at the end of 2013, I decided I want to make a career out of this, which was quite a hard decision to make because my skill sets did not suit this field at all. But I ended up doing it, and in 2014, since 2014 and onwards, I've systematically invested more time of my life into this space. And by now, I have, I'm a show host at Epicenter. I'm a co-founder at Chorus One, which is my company, and I dedicate like 100% of my energy in the crypto space.
And so what was it about Bitcoin that was, appealing to you? Because I think, back in 2012, 2013, even 2014, it was not from an investor's point of view, and I know from your other interviews as well as our conversations that you were always looking to invest, and that was more so in the public equity and debt markets. But so what exactly was it about Bitcoin that you thought was appealing? Because most people who are looking to invest in the public markets would have been extremely uncomfortable investing in Bitcoin. Was there anything in particular that made you believe in it?
Yeah. So I'll start with like prefacing that I believed in something when I invested in Bitcoin at first. I think that thesis is wrong now, the thesis that actually made me invest in Bitcoin, but I'll go through it anyway because a lot of people around the world are still investing as per that thesis. So like one of the central frameworks that I use is I always think a lot about the power of compound interest. Like we've all studied that formula in school, right? Like P equals P naught 1 plus X raised to N, where X is the interest rate, N is the number of years, P naught is what you started with, and P is what you'll get at the end of that period.
Yep.
But it's a magically powerful formula. It is a magically powerful formula because compound interest is actually, you can express compound interest as actually an exponential curve. What starts to happen usually is that when you extend the compound interest formula over long periods of time, it produces fantastical returns. So let's take an example. So something that grows at 20% a year is, so if you think of something that grows at 20% a year, that thing is going to double in around 3 years, a little bit more than 3 years, but let's assume 3 years, like maybe 3.5. So something that grows at 20% will double in 3.5 years, which means it will be 4 times in 7 years, and it will be 8 times in 10.5. And I'm pretty sure if you extend this over 100 years, X will become, I don't know, a million X or something like that, right? It'll be a crazy amount. And when you look back at history, you do realize that with fiat money, compound interest subtly works against you, right? So compound interest is this ferocious tool, and you want compound interest to work for you, right? Like when you have money, if I have, let's say 100 rupees, I want it to grow compounded 20% a year, because if I can grow 100 rupees at 20% a year, it will become a massive quantity by the time it's given off to my children, right? It will be, I don't know, it will be like probably millions or billions of rupees if I can manage to grow it at 20%. But if you look at fiat money has the property of inflation, and inflation is compound interest working against you, right? So if you have 100 rupees, next year the purchasing power of that 100 rupees falls down by 10%. And the year after that, 10% again. And the year after that, 10% again. And in 50 years, inflation is compound interest working against you. That the thing that you fundamentally have to avoid in life. Right? So you see these examples, right? Like so like last summer or last winter, I went to Mysore, and I went to the Royal Palace of Mysore. So this is like this amazing building, right? Like huge, one of the largest palaces in India, huge grounds, huge building. The interesting thing is that palace was made in 1910 for around 21 lakhs in Indian rupees. The whole palace for 21 lakhs. Today we don't get a small one-bedroom flat for that amount. So for a Western audience, 21 lakh rupees is today's $30,000. But the whole palace was built for $30,000, including the land, including all the furnishing. And why is that so? That is because because inflation is compound interest working against you. You are losing wealth by 10% a year, but then you're losing by 10% every year. So it gets compounded against you, and it produces totally weird results. Now, some people say that the island of New York Manhattan was bought for $1 like 400 years ago. That's a myth. This story is a myth. But I think there is some truth to it, right? So $1 400 years ago is equivalent to billions of dollars today. Now, what I felt interesting about Bitcoin was the first currency that could be totally opposite. So normal currencies, compound interest works against you. Bitcoin was the first currency I felt in which compound interest was working for me rather than against me. In other words, it was deflationary. So with Bitcoin, because the units were scarce, but the number of people using this system keeps growing every year, the value of the coin increases. So something where supply is scarce, but the demand keeps growing because the user base grows at 20% a year. So what happens when you have finite supply meeting a growing demand? Well, price has to rise. What does the rise in price mean? That if you think of Bitcoin as a currency, everything is deflationary. So instead of prices falling, prices going up, prices are going down. And wouldn't that be something you want out of your money? You want your money to be such that it would make compound interest, the engine of compound interest, work for you. And that was the simple logic with which my initial investments in Bitcoin were made.
And so you say that this hypothesis that you used to make the investment doesn't hold anymore. How do you think it's changed since you made that investment?
In the early days of cryptocurrency, it was really easy to pick the coin. There was just Bitcoin. And until 2015, I didn't have any altcoins. I bought the first altcoin, which was Ether, in 2015. And at that time, it was like safe to say that it would be Bitcoin that would make compound interest work for you, because that was the only thing that you knew, that if other people were to enter cryptocurrency, they would end up buying Bitcoin and they would raise demand for Bitcoin specifically. It was very easy. Nowadays, I'm not that sure anymore. So especially this year, I feel there's so many great technological ideas and so many potentially great currency systems that are in the works, that I wonder if in like 5 years, the next person entering the crypto space, will they buy Bitcoin or will they buy other things? Like, will a newbie entrant into the space still keep buying Bitcoin, or would they buy other things? I mean, my estimate is there's like 80% chance that the focal point, the Schelling point, will shift away from Bitcoin into other things. And so, like, this thesis, while it was correct from a 2012 perspective, 2013 perspective, needs to be modified to fit a 2018 perspective.
And I'm just curious, does that reflect in the investments that you make or how your portfolio looks like at the moment as well?
It certainly does. So I own like very small amounts of Bitcoin now. It might be less than 5% of my portfolio, certainly.
Okay. Okay. So I plan to dig a lot more into the investment side in the later part of the interview. But before that, I want to focus more on the company that you're trying to build currently. Yeah, so your company is called Chorus One. Could you tell us? You've existed for about 5 months now. You're building a validator node for the Cosmos project. Could you tell us a little bit more about what you're trying to do with Chorus One?
Yeah. So of course, like one of the big themes in this space now is the so-called rise of proof of stake. Lots of projects are switching to or starting off as proof of stake projects. And proof of work has miners, proof of stake has validators. And technologically, miners and validators are very different. So in mining, the focus is on making hash calculations in Bitcoin. You want to compute the most number of SHA-256 hashes per second that you can. But validation is quite different. In validation, basically the mining equipment is the coin itself. So if you want to become a validator for the Cosmos network, you need to have the internal cryptocurrency of Cosmos, which is atoms. And the number of atoms you have determines your voting power or mining power. And so the way it works is if I have 1,000 atoms, I can stake or lock these 1,000 atoms. And then I get like 1,000 votes in the creation of every block. And if Tushar on the other side of the world has 10,000 atoms and locks 10,000 atoms, he gets 10,000 votes in the creation of every block. And the creation of every block, the finalization of every block can be seen as this democratic voting process where all the validators that have locked atoms get to vote. And if 66% agree that a particular block should be added to the blockchain, it is considered final, or it is added to the blockchain. So right now, in the very short term, we are focused on building one of these validator nodes for the Cosmos network. The other piece that is very interesting to the validator side is, I think validation is the beginning of fixed income in the cryptocurrency market. So let's say you have 1,000 atoms and you lock them and you became a validator. Now, if you produce blocks for a year or take part in the voting process for a year, the network will reward you with some interest. So for Cosmos, the canonical interest might be around 10%. So if you lock 1,000 atoms, become a validator, validate for a year, you will get 10% interest. So the 1,000 becomes 1,100.
Quick query there. So is it like that's the total return, right? 10% on the total number of atoms that are there. That's the total reward that will be given to the entire network.
Yeah. But if you lock X atoms and you validate yourself, then after a year it will become 1.1x.
Yeah.
Because you get that 0.1 in interest. So all of the validators get this property. Now, if you think about it, like this is actually a fixed income security, right? Like in the traditional financial markets, I go and buy a bond, and the bond might give 5%. Like Novartis corporate bond might give 5%. And then if I reinvest that 5% I receive into the corporate bond itself, that cash flow pattern is the same as the validator cash flow pattern. It is exactly the same. And so I think, like we think this is the beginning of a fixed income security in the cryptocurrency industry. So we are building a validator, and of course, like the product is, if you're a user that has atoms but that does not want to validate, because there are reasons why validating yourself is quite painful, and it's quite risky and it's quite hard to do. If you don't want to validate yourself, you can sort of delegate your atoms to us, as a first approximation, you can think of it as loaning your atoms to us. And then we'll give you, instead of 10%, we might give you 8 or 9% in interest. We are doing validation, which is the process of generating blocks for a proof of stake network. But we also see ourselves as creating the first fixed income types of plays in the blockchain industry.
So you've mentioned fixed income a few times. Have you? I think because of the nature of this small space within the broader ecosystem that you're operating in, I think it becomes a little bit easier to work out the economics of your business as well. I know that you've been working closely with the Cosmos team as well to build out this infrastructure. There would be multiple factors and variables in play, but what percent, do you have an idea of what percentage of the total tokens would you aim to be staked with you, and what are the approximate returns that you would be looking at? I mean, you mentioned 8-9% returns out of the 10 is going to be passed on to the delegator. Are those the numbers that you're running with?
No, actually, like these are all indicative numbers. Right now, we haven't decided on what we'll pass on to the delegator and what we keep ourselves for the efforts of validating. These are indicative numbers. They might turn out to be close to reality, I guess, but they can change. Part of the reason why it's hard for us to offer an exact number is the network's still not live. We don't know what the live network looks like, what the assumptions are going to be. The interest rate might turn out not to be 10%, but 7%. This could very well happen. So until the network goes live and our product goes live, it's a bit premature to make decisions. Right? Like, so we are building the product, but how to price that product depends on what the market looks like, and it's still a few months out. In terms of like how many tokens in the Cosmos network we expect to validate, I don't know. We certainly wouldn't want to go greater than 15% of the network. That's the upper bound for sure. But whether we get 2% of the supply, 5%, or 10% of the supply, it depends on how well the market responds to a product, how well they feel the user experience is, how trusted a brand we are able to become, and things like that. With the validation market, it is possible to estimate the overall size of the validation market pretty decently, but it is very hard for us to estimate what fraction of this market we will manage to capture, because it's such an early market that we don't know what shall be the basis of competition in this market yet.
But do you think it's going to follow something like a power distribution curve where few of the validators might have most of the tokens in the network delegated to them and they emerge as leaders?
This is a debate my co-founder and I keep having again and again. So the question, it's a very, very good question. And I don't know the answer to it. So the question is like, okay, so there's going to be, let's say, 10 proof of stake networks in 2020, right? And assume these 10 proof of stake networks have a total market cap of, let's say, 500 billion. That's a high number, but so 500 billion. And out of that 500 billion, like 300 billion is being actively staked, right? So when that 300 billion is being actively staked, and on average it's earning like 10%, and then the validators are making 1%, right? So like when, let's say like when Tushar, you stake 1,000 atoms, we make 10 atoms out of your stake at the end of the year. Then if 300 billion is being staked, then the whole validation market, the revenues of the whole validation market are $3 billion, right? Because the validators take away 1% of it. So the overall market is huge. It's potentially quite large. But your question is different. Your question is that if I make a bar chart where each validator is a bar, and the height of the bar is the total amount of assets in dollars that they are responsible for, and I plot all of the validators in the market like that. So maybe there'll be 1,000 validators, 2,000 validators. What does that look like? Does it look like a power law curve where where like some of the validators have very high bars and the others have progressively lower and lower bars, and beyond validator 30, the next 900 validators have very tiny bars. Does it look like that? Or does it look like there's 1,000 validators total? There are bars, but let's say, I don't know, 500 of them are roughly equal in size. Is it like that? Or is it the case where some validator bars are very high and others are quite low? So the question is whether it's like a power law distribution or it is lots of winners distribution. That is the question.
If you think in terms of the differentiators between different validators, from my understanding and my thought process, it would essentially be the brand that you built. So how secure are you to stake tokens with? And the second would be the pricing, right? Are these the two metrics that would differentiate the winners from within this space?
I think these are the two main, at least these are the two publicly visible metrics. Personally, I think there are a few more, but I cannot go into those in this podcast, in a public podcast. But I think, like, to start off with, brand and the commission rate are going to be the determinants. I think the market will settle at some level of commission rates. I think all markets do, right? I mean, like, if you look at the breakfast cereal market, you go to a supermart, hypermart, like all the breakfast cereals are priced in the same range, and I think it will be similar for the validation market.
Yeah, I was thinking more along the lines of the practice for hedge funds and other funds, which is the industry is kind of agreed on the whole 220 fees mechanism, right?
Exactly.
Yeah.
So an industry like the hedge fund has this Schelling point, which is 220. And I think the validation market will also have a Schelling point, right? Yeah. I think it's inevitable. And I mean, like, you can price a little bit higher than the Schelling point if you have a good brand. You can price a little bit lower than the Schelling point and try to increase the amount of assets you have. Those experiments you can do, but I think the market will congregate around some standard. What would become important is the brand, right? So, I mean, like, what is ultimately the brand? I think brands are a reflection of the limited processing capacity of humans individually and even as groups. So, if you think of yourself as like a computer, your processing power is limited, right? The number of information items you can hold, the things you can evaluate is limited, which is why, and many times you don't want to do evaluations. So a brand is a way of making humans avoid evaluations, right? Like, so if I'm in the cereals market, well, Kellogg's is a brand. I could, if I had infinite processing capacity, I would go and try every cereal in the market, figure out which one is the best in quality, and then eat only that. But that has a search cost, right? If I wanted to evaluate every cereal in the market, I need to spend probably 6 months doing it, and that imposes a cost on me. So one way to short circuit that cost is to say, oh, Kellogg's is this brand. I've heard this name 10 times, and while they may not be the best, it is likely that if I buy Kellogg's, they will be at least 80% the quality of the best that I could find myself. So I save 6 months of search cost by just going for the name. So because my processing is limited, I go for a brand, and this is true everywhere, right? So like if you're buying a piece of chocolate, you're going for Cadbury because, well, trying out all the chocolates in the world is going to take 5 years, figuring out the perfect one. But if you go for Cadbury, you're pretty sure that, probably Cadbury is 80% as good as the best in the market. In all markets, brand takes a role, and I think it will be the same in the validation market. When you are delegating money to a validator, you are actually trusting the validator to run operations well, right? And if they don't run operations well, you as a delegator can lose a lot of money. So if you stake 1,000 atoms and your validator produces an invalid block, then you could lose 500 atoms. So ideally, as a user, if I had infinite computing power and time, I would go and check out the infrastructures of each validator in the world. and I would figure out which one has the best mix of operational security and low commission rate. And then I would make that decision. But it would probably take a year, because if you have 1,000 validators, if you're super efficient at evaluating the operational security of these 1,000 validators, then and you could do like 3 a day, it would still take you a year, right? And then after a year, you would make your decision. But humans have limited processing capacity. They have only 2 hours to spend on this decision, like a typical user. So the typical user is going to short circuit that process by saying, oh, Chorus One is a brand. They're probably 80% as good as the best option that exists, and I have only 2 hours to spend on this decision, so let me just delegate to Chorus One. That's going to happen here, which is why brand is going to be important in this market. And then the other scarcity that exists is, for a brand, generally it's like somebody else refers you to it, right? Like your friend says, oh, I delegated with Chorus One. So if you look at like human society as a whole, in all markets, ultimately things congregate around 5, 10, 15, 20, 30 brands in any brand dominated market. So you can have examples of market where it congregates around 2 or 3. You can have examples where it congregates around 50 or 60. If you look at the international banking market, you'll see that probably there are 50 big brands, right? If you count all of the HSBCs and Barclays, there's 50 big brands. If you look at the cold drinks market, there are only 2. No, not 2, but like carbonated drinks market, there are like Pepsi and Coca-Cola. So you have markets there are 2, there are markets where there are 150. So what is the validation market going to be like? It's an unanswered question, but it could be anywhere in between.
To answer it very briefly, what is your view? Is your view that it's going to be highly fragmented, or is your view that we're going to sort of converge towards a few big brands and then everyone else kind of gets a very, very small piece of the pie?
I don't know. So
okay.
From a decentralization perspective,
yeah,
it is certainly nice if the market dynamics of this market if they were to converge around say 50 brands rather than 5. Because if they converge around 5, then all proof of stake networks are going to end up pretty centralized. If you converge around 50, now that's a good distribution, right? Like 50 parties for the main networks, that's quite a good distribution. I think the proof of stake network designers will design their networks in a way that it goes towards 50 rather than 5. And I think many of their design choices are going to influence whether it's 5 or 50. And ultimately, society will realize which design choices lead to 50 rather than 5, and those are the ones that will become popular. So it's not the case that the market exists in isolation, right? Like market exists. Let's say somebody designs a proof of stake network, the market acts on it, and then it realizes that for this design it congregates into 5 brands. Then the next generation of proof of stake designers will be like, that design is centralizing, so let me design something in which the effect of brand is even lower. And so ultimately, I think we are going to see this process of iteration where proof of stake designers will improve over time, and they will try to hit a design where there's 50, and that is where the market will probably stabilize at. That would be my guess.
So there are multiple market forces in play, but the people designing these networks are still quite small in number. So do you think, and I mean, this is something I think about, so do you think there is centralization kind of built into the system inherently? It's kind of like how, it would kind of take a page from history. For the longest time, and this is something that the whole cypherpunk movement stood for as well. For the longest time, it was financial institutions and governments, or all these establishments that kind of dictated terms. And there's kind of like a power shift from these establishments to, you can call it Silicon Valley or technologists in general distributed around the world. But do you think that there is still this element of centralization that is prevalent? It's just that there is a move from a centralization within one faction to a different faction of society?
I actually think there is a computational logic to centralization in society. So just like there's a computational logic for brands, right? Like that's what I said, right? The brands are mechanisms we use in order to save our limited computational power ultimately. I think a lot of the centralization we see in society, centralization of resources, of capabilities, is actually also society's way of saving on its computational power. If you think about it, like if you think of any product in the modern society, there is significant design complexity behind any product, like be it like cornflakes, be it chewing gum, be it shampoo, be it validation. Like if you actually peek behind the curtain and see how this thing is designed, highly complex, almost always. And the number of people with the human capital and the skills to design any product in any space is quite limited. Like the number of people that can design a great shampoo in the world, probably not more than 5,000. I don't think it's more than 5,000. And so why does society do it? Like this is a form of like specialization, right? So we 5,000 specialize in designing shampoos so that you 5,000 as a different group can specialize in designing perfumes. And when like parts of society specialize in this way, society as a whole can produce more good things. So we create these knowledge silos. Society automatically creates these knowledge silos in order that we might use the whole computation power of society more efficiently and build more good things for all of society. But like when you restrict, when the restriction of 5,000 people knowing to design a good shampoo happens, and only 5,000 people know how to supply this shampoo all over the world, the company that controls 2,000 good designers and 2,000 good supply chain experts of shampoo is going to have a massive advantage over the company that has only 10 designers and 10 experts. So if you think of it, like what is centralization? I think centralization, one of the reasons of centralization is the human tendency of specialization of labor. Specialization of labor automatically leads to few people having expertise in topics. And then the companies that control, like that employ these few people and make a combination out of it have an advantage over those that don't. And this is what ultimately leads to some form of centralization. Right? The shampoo making business is pretty centralized. Like, remember, 6 or 7, not more. I think this is a pattern beyond crypto, beyond Silicon Valley, Wall Street. Like these are like Silicon Valley, Wall Street are just manifestations of this pattern, but this pattern exists on a level which is deeper. I think it will be similar ultimately for proof of stake and validation, right? Like the number of experts that can design secure validators. Well, I mean, does society need 100,000 experts to do this? No. Society probably needs 5,000 experts in this topic, and that's enough. Ultimately, there is a limit to how much we can decentralize, even validation. Because beyond the point, like what is the most decentralized system? The most decentralized system is that 10 million people know how to build a validator, right? Like 10 million people have the skill sets of building a validator. But that's like on a societal scale, that's very inefficient. Like you could have used these 10 million people to specialize in other things and produce more for society if they specialize in other things. So perfect decentralization is highly inefficient, right? Probably the societal optimal is to have these, like, let's say 10,000 people specialize in validation, and then these 10,000 people to be controlled in 50 different companies, and then these 50 different companies give decentralization, and that's enough distribution of power. I think that's the best outcome we can have. If you want to decentralize more, you will create other perverse outcomes in society. And I think like power is shifting away from Wall Street to Silicon Valley. It is just a result of that the specializations that matter are changing. So now, like for example, like AI and big data is a new specialization, and the people that are specialized in AI and big data are now in Silicon Valley. So which is why there's a shift from Wall Street to Silicon Valley. I don't know if I answered your question.
I think you answered that beautifully. I mean, I think that's a great way to think. I've actually never personally thought from that perspective. I've never come across someone who's answered this question the way you did. And so I think that was quite amazing. I mean, at least for me.
Thank you. Yeah, I'd be glad to have comments on this.
No, I think I need a while to digest it. But I think I know exactly where you're coming from. And again, like I mentioned, I've never thought from this perspective before. Again, I know that we've tried to build specialized skills for thousands of years now as a species in general. But yeah, I mean, I think it's just the way you articulated the whole answer was quite good. All right, guys, I'll stop this week's interview right here to not make it too long. I will be releasing the second part of my conversation with Meher, the juicier part about investing, next week. Thanks for listening, guys. If you enjoyed this episode, please subscribe to this podcast on iTunes, Google Play, SoundCloud, or wherever you listen to podcasts. Like us on Facebook, Twitter, LinkedIn, and Telegram, and subscribe to our newsletter on decrypt.asia. This is your host, Tushar. Thank you for listening.